Welcome to the Deep Dive, your shortcut to being truly well-informed. Today is August 8, 2025. We're diving deep into some fresh financial results from a real global powerhouse. These quarterly updates, they're more than just spreadsheets, right? They're like a health check, a snapshot of where a company stands and where it might be headed. Especially in automotive, things move fast. So for this deep dive, we're tackling the Q1 FY26 results for Tata Motors Ltd, a massive player globally. We've gone through, well, stacks of material for you: official filings, press releases, earnings calls, investor decks, the works. Our goal, like always, is to pull out the key insights you really need.
Exactly. Want to cut through the noise, the financial jargon, highlight what's genuinely surprising, and give you clear takeaways on what these numbers, these strategies actually mean. For the company, it's different parts, and the whole auto industry picture. What's the real story here?
Okay, sounds good. So we've set the scene. Let's get into it. Tata Motors Q1 FY26. What's that first overall consolidated view look like? The big picture.
Right, so looking at the consolidated numbers, revenue came in at 104,400 crore rupees, which, just for context, is roughly 12.5 billion US dollars. That's actually down slightly, 2.5% year on year. But here's where things get, well, more challenging. EBITDA, that's earnings before interest, taxes, depreciation, and amortization, was 9.7 KCR. That's a big drop, down almost 36%.
Wow, nearly 36%.
Yeah, it really shows the kind of margin pressure they faced immediately this quarter. Then you got PBT, profit before tax and exceptionals, at 5.6 KCR, and a key one. Auto free cash flow is negative 12.3 KCR.
Meaning they burned through cash in the auto business this quarter.
Essentially, yes.
Yeah.
More cash went out than came in from core operations. And their EBIT margin, operating profit margin, landed at 4.3%. That's down 3.7 percentage points. Quite a squeeze.
Okay, so those main numbers definitely show some pressure, but then scrolling down, I see this pretty large number for profit from discontinued operations. It really bumps up the final net profit figure. That seems significant. What's behind that? And does it paint a maybe slightly misleading picture of how the actual business performed operationally?
That's a really sharp observation. And yeah, it's crucial to unpack that. That 4,975 CR profit from discontinued operations, it is a one-time thing. It comes purely from selling their Tata Motors finance business to Tata Capital.
Ah, okay. An asset sale.
Exactly. So it boosts the reported bottom line, the net profit, absolutely. Yeah. But, and this is the key point, it doesn't reflect their underlying operational performance for Q1. It's an accounting gain, not ongoing business profit.
Got it. That makes sense. So moving beyond the pure financials for a moment, what major strategic moves, like corporate actions, did Tata Motors make this quarter? Things that will really shape their future structure.
Well, there were two really big ones. Monumental, you could say. First, the demerger. The final hearing for splitting the company, separating commercial vehicles, emerging passenger vehicles with the listed entity actually wrapped up today, August 8th.
Today, okay.
Yeah, at the NCLT, the National Company Law Tribunal. The order's reserved now, and they're planning for the effective date to be October 1st, 2025. This is huge structurally. Two separate, focused listed companies.
Right. Unlocking value is usually the goal there.
Precisely. Yeah. And the second big move. On July 30th, they announced a voluntary tender offer to buy Iveco Group, well, 100% of it minus the defense part. That's valued around 3.8 billion euros.
Iveco, the truck maker.
That's the one. Strategically, this looks like it's about combining complementary strengths, especially in commercial vehicles, and boosting their global footprint. They expect that deal to close sometime in the first half of 2026.
Okay, so demerger nearly done, major acquisition in progress. Anything else on the corporate front?
Just a couple of other points. On a positive note for the group, JLR got a credit rating upgrade from Moody's to B1. That signals better financial stability.
Good sign.
Definitely. And then there's this new regulation, Extended Producer Responsibility, EPR, for end-of-life vehicles. Started April 1st this year. It basically means car makers, the OEMs, have to buy certificates based on steel used in cars they made 15, 20 years ago, pushing recycling responsibility.
Interesting. So they have to account for the end-of-life impact now.
Sort of, yeah. The actual cost is still a bit fuzzy, though.
Yeah.
They're waiting for more clarity from the Central Pollution Control Board on exactly how it works and the costs involved.
Okay, quite a lot happening besides just the quarterly numbers. Let's pivot now to JLR, Jaguar Land Rover. Often the profit engine, right? I'm really keen to understand what happened there this quarter. Sounds like it was tough.
It certainly was a challenging quarter for JLR, no doubt about it. Revenue dropped 9.2% to £6.6 billion. Profitability took a hit. EBITDA margin fell 6.5 percentage points, down to 9.3%. And the EBIT margin, operating profit, shrank almost 5 points to 4.0%.
Ouch.
Yeah. Profit before tax was $351 million. That's nearly half, down 49.4% compared to last year. And free cash flow, a significant outflow. They used $758 million more cash than they generated.
Mm-hmm.
Wholesales were also down 10.7% to 87,300 units. That was partly due to a temporary stop on shipments to the U.S., plus they're winding down some older Jaguar models as planned.
So what drove that big hit to profit and cash?
It was really a perfect storm of factors. The big immediate one was a new U.S. trade tariff,
Yeah.
an extra 25% slapped on vehicles and parts imported from the U.K. starting April 3rd.
On top of the existing tariff.
Right, on top of the standard 2.5%. So they were paying 27.5% for the whole quarter. That hit the bottom line directly, materially. Then you had the U.S. dollar weakening, which particularly impacts how their crucial China earnings translate back, plus just general challenging industry dynamics in China itself. And to add to it, they had some costs related to historical warranty recalls. That showed up as a depreciation and amortization charge, a non-cash expense, but it still weighs on reported profit.
Wow, okay. Tariffs, FX, China market, recalls. That's a lot to handle. But you mentioned a pause in U.S. shipments. And I thought I heard something about trade deals recently. Is there any relief coming on those tariffs?
You're right, there has been movement. Thankfully, some mitigation is happening. A UK-US trade deal was signed, effective June 30th. That cuts the tariff on UK cars going to the US from that painful 27.5% down to 10%.
Okay, that's much better.
It is. But it's only for the first 100,000 units each year. And there was also an EU-US deal announced July 27th. That reduces the tariff on EU-made cars, like some JLR models, from 27.5% down to 15%.
Those are definitely better than 27.5%, but still higher than before all this started.
Exactly, that's the catch. It's a significant reduction, yes, but compared to the original 2.5%, the new UK rate is still 300% higher, and the EU rate 500% higher. So an improvement, but not back to square one.
Oh, and another bit of relief, JLR is releasing some balance sheet reserves because those U.S. federal CAFE penalties, the emissions fines, got reset to zero. That helps the financials a bit, too. Okay. Despite all those headwinds, though, are there underlying strengths still showing through at JLR?
Oh, absolutely. You have to look past the immediate quarterly hit. Their brand power is still immense. They hit a record revenue per car, £76,000 on average. That's huge. And get this, 77% of their sales came from the high-margin models, Range Rover, Range Rover Sport, and Defender. That's where the real money is.
So the product mix is strong.
Very strong. And new launches are building excitement. The Range Rover electric prototypes, they already have a waiting list over 65,000 long.
65,000, wow.
Yeah. Plus, they launched the Defender OCTA Black Edition, new Discovery Editions, the Jaguar Type 000 concept. And their big reimagined transformation strategy is ongoing. They have these 14 internal missions, things like tackling CO2 costs, improving customer experience, mitigating those U.S. tariffs. They aim to deliver $1.4 billion in value each year through those to offset risks. And their big investment plan, $18 billion over 5 years, that's still on track.
Okay, so they're playing a long game. What's the outlook JLR gave?
They actually kept their full-year EBIT margin guidance unchanged, 5% to 7% for FY26. And they expect free cash flow for the full year to be close to zero. So basically, they see this quarter's outflow reversing over the rest of the year.
All right, let's switch lanes now. Commercial vehicles, Tata CV. How did that part of the business fare, especially with market conditions being a bit soft, maybe?
Tata CV actually showed quite a bit of resilience. Revenue was 17.0 KCR, which was down 4.7%, a slight dip. But interestingly, their profitability improved. EBITDA margin went up 60 basis points to 12.2%. And EBIT margin improved too, up 80 basis points to 9.7%.
So lower sales, but better margins. How does that work?
It came down to better pricing, or realizations as they call it, and savings on material costs. That offset the impact of the lower volumes. Their profit before tax, including exceptionals, was solid at 1.7 KCR. And that ROCE figure, return on capital employed, was really strong, almost 40%. Shows they're using their capital very efficiently.
And the market itself, you mentioned soft conditions.
Yeah, the overall domestic CV market was subdued. Volumes down 9% year-on-year across the industry in India. But Tata CV saw a bright spot in exports, up a very healthy 68%.
Okay, big jump there.
Huge jump. Within the domestic market, it was mixed. Heavy trucks, the HGVs, and small pickup trucks were a bit muted. But buses, vans, and the medium-sized trucks, ILM-CVs, they actually saw some modest growth. So a varied picture, but resilient overall.
What about new products or tech in the CV space?
They're definitely pushing forward. Launched the Ace Pro, which they're calling India's most affordable four-wheel mini truck. Comes in an EV version too.
Targeting that value segment.
Exactly. They also started offering air-conditioned cabins across their truck range, focusing on driver comfort. And a pretty cool tech win. They secured an order for 25 big articulated electric buses for the city of Nagpur. These use flash charging tech. It's a pilot, really, for advanced public transport. Plus, their existing electric bus fleet, it's now crossed over 400 million kilometers cumulatively, with really high uptime, over 95%. Shows the tech is reliable.
That's impressive mileage. Are they doing much on the digital side for CVs?
Oh yeah, that's scaling up fast. Fleet Edge, their connected vehicle platform, has over 825,000 vehicles active on it now. And they say 80% of users are active monthly. That helps customers manage their fleets better.
Right. Data driving efficiency.
Totally. They have another tool, Mileage Sarathi, which they claim has improved fuel efficiency by about 6% for users. Direct cost saving. Then there's Educan for online spare parts. Thousands of customers and tens of thousands of retailers are on board. Makes getting parts easier. And Fleet First for selling vehicles online. That drove over 10,000 sales in Q1 alone.
So digital is becoming a serious channel.
Absolutely. They said digital channels contributed to about 28% of their retail sales in Q1. That's significant.
And the outlook for CVs.
They expect volumes to pick up in the coming quarters. They're banking on forecasts of a good monsoon season, maybe some interest rate cuts helping finance purchases, plus the government's continued push on infrastructure spending, and of course the upcoming festive season usually boosts sales.
Okay, makes sense. Let's move to the final business segment. Passenger vehicles, Tata PV, including the very important EV side. What's the story there?
Tata PV faced some similar softness. Revenue was 10.9 kcr, down 8.2%. Profitability also took a knock. EBITDA margin was 4.0%, down 1.8 points. And EBIT was actually negative, at negative 2.8%, down 3.1 points.
So a loss at the operating level.
At the EBIT level, yes. Profit before tax, excluding exceptionals, was slightly negative, minus 0.1 kcr. Wholesale volumes were 124,800 units, down about 10% year-on-year.
What drove that?
Similar factors, really. Soft overall industry demand, especially in May and June, were apparently weak months across the board. Plus, they had model transitions happening, which can temporarily disrupt volumes as you phase out old and bring in new. Profitability was hit by the lower volumes and pricing pressures, although they did manage some cost savings, which helped partially offset it.
And the EV part of PV, how did that fare?
That's where it gets more interesting. EV wholesales were actually down slightly, too, 2.1% year-on-year, at 16,200 units. But crucially, EV penetration, the share of EVs in their total PV sales, held steady at 13%.
Okay, so maintaining their share despite the dip.
Right. And then came July, just after the quarter ended. Their EV division, TPEM, had its best ever month for EV sales. Market share bounced back really strongly to 40% in July. It had been around 36.7% in Q1.
What caused that July surge?
A big factor seems to be a major initiative they launched. And a lifetime high-voltage battery warranty.
Lifetime, wow.
Yeah, for their newer Curvy.ev and the long-range Nexon.ev models. That seems to have really boosted confidence, bookings, and sales significantly in July. It's a bold move.
Definitely a statement. What about other new launches?
They had good success there, too. The Harrier.ev apparently got over 10,000 bookings on its very first day. That builds a strong order book for the coming quarters. They also launched the all-new Ultras hatchback. And bookings for their Tiago and the existing Ultras combined jumped 22% in June, so some renewed interest there as well.
Okay, so new launches are helping. What are the main challenges looking ahead for PV?
Well, the volume pressure seems particularly intense in the lower price segment, cars under 10 lakh. It's super competitive there, and they noted sustained high levels of discounting across all manufacturers. It's a price-sensitive market.
A discount war, essentially.
Kind of, yeah. But despite that, Tata feels they're well-placed to do better than the overall market because of these new launches, both petrol, diesel, and EV, and that strong EV momentum they regained in July. Oh, and on the emissions front, those CAFE 3 rules, they don't expect delays, just ongoing discussions about exactly how strict the final rules will be.
Right. So we've looked at consolidated, JLR, CV, PV, brings us back to the overall financial health. After seeing some negative cash flow and margin pressure, how strong is Tata Motors' financial position to handle all this, plus fun things like the Iveco deal?
That's the key question, isn't it? Looking at the health indicators, there's underlying strength. Finance costs, for instance, actually went down quite a bit by 533 CR, mainly because they've been actively reducing their overall gross debt. That helps.
Lower interest payments. Good.
Exactly. Now, that negative auto free cash flow of 12.3 kcr this quarter, that was mainly due to working capital swings, seasonality, plus paying for those tariffs up front. But importantly, the company expects this to totally reverse over the year. They're sticking to their guidance of positive free cash flow for the full fiscal year.
So they see Q1 as a blip in cash flow terms.
That seems to be the message, yes. Net automotive debt did go up seasonally in Q1 to 13.5 KCR, including leases. That's expected when cash flow is negative. But their overall liquidity position looks very solid, 5.0 billion available. That includes a big 1.7 billion credit line they haven't even drawn on. Plus, just recently, August 1st, JLR secured another £1 billion loan facility backed by the UK government's export finance agency, UKEF.
So plenty of access to cash if needed.
Seems so. And their debt maturity profile is well spread. No big lumps of debt coming due all at once in the near future. That provides stability.
Okay, so wrapping this all up then, it's pretty clear Tata Motors had, well, a genuinely challenging first quarter. Lots of external pressures, trade issues, market shifts, impacting different parts of the business in different ways.
Absolutely right. You see those immediate headwinds quite clearly in the numbers, especially for JLR and PV margins and that consolidated cash flow figure. But underneath that, you also see them actively pushing their long-term strategy, transforming JLR with U-Tech and aiming for recovery, keeping CVs resilient and innovating with digital, and really leveraging new launches, especially EVs, with things like that lifetime battery warranty to drive the PV segment forward. And those big corporate actions, the demerger, the Iveco bid, they show a company looking well beyond the current quarter, making bold moves for future growth and leadership, not just playing defense.
Right. So despite the Q1 bumps, the strategic direction seems quite aggressive and forward-looking. And that leads us to our final thought for you, the listener, to mull over. Given these aggressive moves by Tata Motors pushing hard into EVs, restructuring the entire company, acquiring major international players like Iveco, all while navigating these tricky global trade winds, how might these kinds of strategic shifts by such a major global player fundamentally reshape not just the car industry itself, but maybe the whole idea of mobility in the years ahead?